All righty, welcome back, everybody. This session is on dollar cost averaging, HODLing, and rebalancing with digital assets. And we've got a great panel for us right here. Christopher King is the founder and CEO of Eaglebrook Advisors. Hey, Chris, how are you? Chris founded Eaglebrook in 2019 to build a bridge between wealth management community and the crypto community. And today, Eaglebrook is one of the largest SMA platforms in the crypto marketplace, managing over 100 million and serving wealth management firms and advisors. And disclosure, my wife Jean and I are investors in Eaglebrook. Matt Kolesky is president of Arbor Capital Management. He's been in the financial services industry for 20 years. He's been both an advisor and CCO for Arbor Capital. And John Maier, who is the CIO, the Chief Investment Officer of Global X ETFs, where Jean and I own a bunch of your ETFs. We're big fans of Global X. Prior to that, he was the lead model portfolio strategist at Merrill, and he now leads Global X's market outlook, construction of model portfolios, and he crafts the firm's investment strategy. You see John often in the Wall Street Journal, Reuters, Bloomberg, and other media. So Chris, let me start with you. Talk about the various ways that advisors can enter the digital assets marketplace.
Yeah, of course. Thanks, Rick, for having me. Really excited for this conversation. So I think the market entry strategy is the number one question for new investors entering this market. They see the volatility and kind of the first question they ask is, hey, how do I make sure I'm buying a dip or getting in at a good price? We think of it a little bit differently. And I think there's no one size fits all. Generally speaking, we think the best way to enter the market, if you're investing, let's say less than 250 grand, is to do a market order, right? And just basically get it in the market, get exposure. That makes, a lot of sense if you're investing for the first time, as opposed to what we've seen where a lot of clients want to invest, but they think it's at 30,000 or 40,000 and it's going up. They're waiting for this dip and it never happens. And they end up getting in at 60,000 where we are now. So that's kind of one area that we recommend is kind of, if you're going to invest when you're ready. But we also recommend cascading limit orders. So you can set 3 or 4 limit orders moving down the market, right? So, we're at 64 right now. You can set one at 62, 60, 58.5, and maybe 55. And as kind of the market comes down, we could potentially hit that. So you can use technical indicators for that. And then obviously dollar cost averaging, but there's a multitude of different strategies. For dollar cost averaging, we typically do 10% per week for 10 weeks. That's a strategy that we recommend for a lot of clients that are trying to put in, let's say, north of $1 million. And then I would say for clients that want to move in a 24-hour period, but they have a $5 to $10 million trade, we'll do a 24-hour TWAP, right, where it invests a certain amount every few minutes over a 24-hour period that can, limit the price volatility and the slippage for those accounts. So those are the various ways we enter the market.
In other words, the fundamental investment strategies that we use all the time in our practices are readily available in the digital asset space. There's nothing new or different or unusual. And we're, as advisors who are new to digital assets, not new to that. And so managing a digital asset portfolio is really something you are much better at than you realize, even if you've never done digital assets before.
That's exactly correct. Yeah.
So Matt, let me ask you this. How do you manage digital assets and an overall investment strategy for clients? What's your thesis for digital assets?
Yeah, our thesis is based on blockchain technology adoption and network effects. And so I would say that yes, you can apply a lot of the traditional methodologies to digital assets, but I want to point out something that I think is unique. And if we look at our cues from the tech sector, specifically within the S&P, right, it's just taken over in the last 10 years. And so when we approach digital assets through that technology lens, and the purpose of this session, right, about rebalancing and DCA, we have to have the ability to let it run. And Chris is exactly right. Yeah, it's like you need to know your clients, right? So we're also advisors, and some clients are going to be comfortable letting it run. So that's the approach we take. We need to be flexible because this asset class is it's evolving extremely rapidly and will continue to evolve. And the other point, the infrastructure between the traditional and digital world is going to continue to come down, and we need to be mindful of that. These trade 24/7, which is it's not 4 o'clock on Friday in New York, and hey, we're done for the weekend, right? You can use that as an opportunity if you have clients that are coming on board. There's a dip on Saturday or Sunday morning. Hey, let's get this invested. So that's the approach that we take.
John, let me ask you, what's the best way you find for approaching the rebalancing issue? Should crypto be rebalanced the way you do a multi-asset portfolio, or should you treat it differently because of the higher volatility?
That's a good question, Rick. I think it depends on how you use it. And I do think that cryptocurrencies and digital assets should be rebalanced more frequently. You may own currencies like Bitcoin or Ether to limit volatility and minimize risk while using other cryptocurrencies that have smaller, lower market cap cryptocurrencies, which you likely will need to rebalance more than your typical multi-asset portfolio. Just think about some of these assets.
So does that mean you have broader bands, or to reduce the number of trading that has to be done, or you just simply acknowledge, you're going to rebalance more often because it's more volatile asset class?
Yeah, I think you have to acknowledge that you're going to do it more often. To Matt's point, markets never close. You can rebalance anytime during the day, on a Sunday, at midnight, whenever. Some of the best traders in the crypto space rebalance on a daily basis, and some even on an hourly basis. So you may be able to use cryptocurrencies in your broader asset allocation, but you need to bucket it and think of it a little differently and manage it differently than your other typical multi-assets, your stocks, your bonds, and your alts.
For ordinary retail investors, do you think rebalancings with such incredible frequency, hourly, daily, is practical?
It depends how you access it. So if you're, perhaps if you have a separate bucket, if you're using one of the exchanges, Coinbase or Gemini or whatnot, it's only feasible if you're doing it in conjunction with somebody else. Your financial advisor is not going to be rebalancing it on an hourly basis for you. That's for sure.
And the tax implication will be a thing, and the wash sale rule will be a thing. So inside an IRA makes it a whole lot easier.
Sure.
So Matt, talk about your rebalancing process.
Yeah, so the rebalancing process, I'll take that and answer it two separate ways. The first one is rebalancing digital assets back into other asset classes. And so we've done that over the last couple of years using GBTC specifically. And like you mentioned earlier, Rick, we had some pretty wide bands around that. And so we would use that volatility to create a fair amount of value in our alternative sleeve. Now, as the asset class continues to mature and evolve, we can rebalance within the asset class itself. So we are moving beyond just Bitcoin and into Ethereum and other assets. We can still rebalance back to the other assets, but we're also, the other asset classes, but we're also rebalancing within the asset class itself. And so we have.
So that's really interesting. In the past, you're saying that it was either in or out of Bitcoin, therefore in or out of the digital asset space. Now it's acknowledgement that there's a wide array of coins that are suitable. And so it's no longer an in or out. It's a question of weighting, WEI, not WAI, to determine which is the mix of Bitcoin versus Ethereum and other coins. And that's a big significant metamorphosis in this asset class, wouldn't you say?
Yeah, absolutely. I want to point out we never went to zero. I think it's one of the things that you always say, right? 1%. So even when we were rebalancing back, we were just taking it back down to its target weight, and we still manage it that way within clients' portfolios as a percentage of their net worth. But yes, it changes the process of rebalancing within the asset class itself, for sure, because there's a lot of different dynamics in play and correlations that are being developed, literally right now in the last few years.
Now, Chris, John mentioned, the notion, say at Coinbase or Gemini or whatever, you could rebalance, over the weekend. You can do it at midnight because it's a 24/7 traded asset. Advisors, of course, are not going to do that on weekends or in evenings. They're not going to do it in an account that is managed by the client. They're going to do it in an account they manage. So from your viewpoint, how do you see advisors handling the rebalancing? Are they doing it any different than the rest of the portfolio?
So I think there's two differences, right? Rebalancing within the digital assets, right? If you're like 50% Bitcoin, 25% ETH, 25% DeFi, how often do you rebalance that? And then how often do you rebalance it if you have a 5% position in your portfolio? So I'll start with like the digital asset piece of it. most advisors, if not, I would say probably 100% of advisors, they don't want to do the rebalancing. They don't want to do the trading. They don't want to do the investment management. They've decided to allocate, 4 or 5% of their portfolio, and then they want to outsource that, right, to someone else, to me, to Matt, right, to another manager in the space. So how we think about that rebalancing is, we do it all, and we typically do it on a quarterly basis. But we also can do it on a discretionary basis for a more active strategy. So if someone goes into our 70-30 strategy, we rebalance and reconstitute on a quarterly basis. But for our actively managed DeFi strategy, for example, that is completely discretionary rebalancing that you can move assets in, right? You can reconstitute it, or you can, discretionary rebalance. But we also have like max position size. So like if Uniswap goes to over 40%, right, we'll sell that down. So there's different things on the digital asset side. What we're seeing in the market, which I think is a little bit different from what we've been advisors talking about, like IPSs and rebalancing and things like that, that is kind of, they see crypto outside of that piece of kind of their portfolios. They view it as an alternative investment with a 5-year time horizon. So if they're going to set, let's say a 2 to 6% allocation, they're going to let that run unless it hits like a max position size of like 25%, then they can start to sell it down. That's the way we think it should be done. And, some of the most sophisticated clients we work with, they're just like, hey, we have a 3-year investment time horizon or 5-year investment time horizon. We're not going to touch this at all unless it goes below like the threshold. We'll opportunistically buy it, like they did when Bitcoin went from 64 to 29. We had clients actually add up to go back to like the 4% allocation. So that's what we're seeing in the market right now from the advisors we're working with.
Yeah, I think that the nature of this asset class with its incredible growth relative to other asset classes is kind of forcing investors and their client and their advisors to pay close attention to the asset allocation, because if you started with a 1 or a 2 or a 3% allocation and you haven't paid attention, it's probably now 8 or 10 or 12. And all of a sudden your portfolio is wildly overweighted compared to what your original intent was. You're either going to be excited about it and leave it alone, or you're going to freak out at the excess overweighting and you're going to have to do something about it. And one of the contributing factors to this, John, is leverage. We know there's a lot of leverage in this space, and that's got to be contributing to the volatility. And if you agree with that premise, tell me if you do. Can you exploit that? Exploit the markets by buying the dip even more so than you might ordinarily, say, in the stock market?
Yeah, and I think you can actually when you're buying it directly. I would say there are multiple exchanges that are offering 100 times leverage, or in some cases even slightly north of that. But the largest exchanges are more bought about 20 times leverage. So there is a correlation to Bitcoin and Ethereum to movements in, at least recently, the NASDAQ and the S&P. So when they're a risk asset. So when they are drawn down some of the leverage gets washed out of the system. And I think that becomes a good entry point. But when you're looking at Bitcoin's historical returns, there's a pattern that can be seen. So some of these hyper-driven demand crazes shoots the price up, but when the fall comes, it's been able to hold a higher low than it did previously. But I do think there's an opportunity. So right now, because of the ETF, the ETF that just came out today, I wouldn't be a buyer today, but likely in a few days, it'll pull back, and that's when I would be a buyer. But it seems to be hitting higher lows than it previously did, particularly for Ethereum and Bitcoin. So I would, if you're going to enter, kind of wait for those periods of a pullback.
And you're referring to the Bitcoin futures ETF.
That's correct.
That is released. When you say a pullback, I guess your attitude is that with the release of the ETF, there's enthusiasm. The price of Bitcoin is up 4% today. You're thinking that will dissipate, and are you expecting a significant pullback?
Not a significant pullback, but certainly I expect a pullback. Almost every time you've seen a run up, it does pull back some. So you might as well jump in on the pullback.
Yeah, so it's an opportunity to capitalize on it.
Yeah, there's the fear of missing out. But one point I want to make, as some of these products, the ETF, the Bitcoin future ETF, and as it gets into some of the wirehouses, and when there's the possibility for using this in a broader asset allocation, then the market is going to start to rethink how big of an allocation do you want to be exposed to. So that 4% position that goes to 10%, but your position size is targeted at 4%, that's when there'll be more frequent rebalances from a firm level, if it gets to that point.
And Matt, has your allocation to digital assets changed over time?
Oh, yeah, absolutely. We started just Bitcoin with a small weighting, and we've continued as the asset class evolves to further diversify and then increase the weighting that we're comfortable with knowledgeable clients that understand the risks that that have been on the journey with us. And so this year we've added gotten more into DeFi, into other platforms and protocols, the ones that we've been talking about on the call. And I think it's really important to say that yes, this is going to continue to evolve, and it's probably the upper bounds of what people are comfortable with is going to continue to increase. And we're getting, I think I've mentioned this on another opportunity, but we're talking to clients that come in with, hey, I've got $400,000 of Cardano and that's all I have. What do I do? And so it's literally shifting. And Chris, yeah, you're nodding your head. You're seeing this too. It's shifting the advisor's role to be able to help these younger people that have made a tremendous amount tremendous amount of wealth. And so should we just not help them because they're asking for help and we don't necessarily know? So yeah, we are. Now that's a different conversation for sure, but yeah, we have to change as advisors how we think about this asset class.
And Chris, you were nodding your head. So what are you seeing advisors recommending for their clients in terms of allocation?
Yeah, so we're seeing anywhere between 2 and 6%, kind of like I said. I think more advisors that are first moving in. Back in November last year, 2020, when we launched, we kind of saw like 1 to 2% get off zero, get skin in the game. Now, when people are allocating, advisors are allocating and talking to clients that are ready and understand the risks and have gone through your training program and all that stuff, they're all allocating between 4 and 5%, which I think is a lot higher than everyone recommended. Now we're only working with 400 advisors, but that's a pretty significant, data point that's what we're starting to see in the market. And then another interesting point is that when we first started off, it was, hey, we only want Bitcoin. We don't want any of that other stuff, right? Now, 80% of our advisors, the first time they're allocating, they're buying Bitcoin and ETH. And then now, I don't have the exact statistics, but a lot are actually now moving into DeFi, other layer 1s, layer 2s, interoperability protocols, that I think they're understanding that this is going to be a multi-chain and a multi-asset world in the crypto space. And they think there's major advantages to that. So we're starting to see that shift in the advisor market. And then also to Matt's point, it's a little off topic, but we're starting to see a lot of advisors realize that clients have a ton of crypto and that they can actually add that to their AUM, right? So they're first looked at this as an accommodation. Hey, my client's calling me about Bitcoin. I got to answer it. Now it's, oh, wait, I can add $10 million organically just through offering crypto and then transferring over their ETH or Cardano, and then I can manage it. So that it's a business opportunity, not an accommodation for these advisors.
Advisors are in, they're delusional when they say my clients don't own Bitcoin. They're in such denial. It's crazy. And when they begin to open up and have conversations with their clients, the clients are more forthcoming saying, yeah, I'll move my Bitcoin over to you since you're managing all my other money. And so, yeah, it's a great way to collect new AUM. The traditional approach, I think, for most folks, as we've all kind of talked about, is you start small, 1% allocation as you get used to this, and you do it in just Bitcoin. So if you're gonna, put a toe in the water, it kind of makes sense, 1% Bitcoin. But eventually, people begin to see the volatility of Bitcoin. Can you, John, reduce that volatility by adding other coins, such as, is Bitcoin plus Ethereum lower in overall volatility than just Bitcoin?
There's a high correlation among many of the coins, particularly Bitcoin and Ethereum. There's some other smaller coins that, trade however they trade because they're small, but you can diversify in some way by utilizing the blockchain. So, we have a blockchain ETF, which looks at digital asset hardware, digital asset integration. So the ecosystem is broader than just purely the actual cryptocurrencies. And then you could even broaden it out from there. Exposures to companies that have some aspect of digital blockchain technology. Fox, for example, is the first major media company to have delve into the NFT space, or Disney with collectibles, or Warner Music. So there are ways to diversify with blockchain technology. But if you're looking at the larger currencies, you're going to have a high correlation in movement, from my perspective.
So, given that, Matt, when you think about digital assets, are you doing that in isolation, or are you doing that in the context of how the digital assets sleeve impacts other investment strategies?
Yeah, it's a little bit of both. We think of the digital asset class in isolation, but when we think about on the traditional side of the business, how else we can gain exposure to what John was talking about, some of these other products. And as we've all seen, and I think you started the discussion earlier this morning with, right, we're all familiar with PayPal, Square, Tesla, Mass Mutual, everybody's getting, JP Morgan has an interesting relationship, but everybody's getting into this, right? Institutional adoption is coming. So what does that mean even on the traditional side? How do we incorporate the thinking there? But specific to digital assets, because they're, they're literally protocols, right? There's different attributes, there's different volatility metrics that you were just talking about that we have to pay particular attention to that might not be as dramatic on the traditional side.
John, we saw recently that El Salvador named Bitcoin legal currency, legal tender. Panama and Paraguay say they're going to do the same. Cuba is moving in that direction. Are digital assets becoming more legitimate, or are these just one-offs from economies and countries that are so unstable in their economies and governments that they don't have a choice but to do this Hail Mary? What do you say?
Well, I think countries are looking at digital currency options, but they're looking to digitize their own currencies, whether it be China, potentially the US. And I think digital assets are more than just a form of money. Some believe that they're a new monetary system to essentially liberate us from central banks and government oversight. And that would be the goal of some. And DeFi, decentralized finance, builds on that, internet native contracts, loans, and it there's a lot of applications beyond just currency. So there's certain countries that their currencies aren't strong. So by decentralizing, potentially that's going to open up opportunities. Other countries are going to hold their currency dear, and if it's digitized, it's going to, it's not going to be. They're not going to adopt Bitcoin or Ethereum.
And our final question, we're close to running out of time. Our next to final question, because I'm going to leave one takeaway that I want you each to offer for everybody watching. But Chris, doing this via an SMA, is there more than one approach? How do you choose the SMA strategy?
Yeah, that's a great question. I think, like Matt was saying, it's not a one size fits all. Some of our clients just want 100% Bitcoin with tax loss harvesting. Some want, right, no Bitcoin. They want ETH and DeFi, right, and yield strategies and all that stuff. We just launched a risk managed strategy where it limits the volatility. It's tactical, risk on, risk off, which can, won't capture all the upside, but won't capture all the downside. One of the biggest objections for clients or advisors is, oh, what about the volatility? Well, if this can reduce the volatility, can move more assets into the market. So I think it's providing all of the education, which you guys do a great job at. We try to do it as well. Give them the information and let the advisor decide. Because in the end, we're not talking to the end client. We're trying to educate the advisor and work with them so that they can decide on what the right, is it 2%? Is it 4% of the total portfolio? And then what do I actually want to invest in? If it's just Bitcoin, that's fine. But if it's Bitcoin, ETH, DeFi, and all these other things, let's think about how to do it properly, how to rebalance it, and then how to articulate that to the client. So that's kind of what we work on with the advisor we're currently partnered with.
Terrific. We just have one really good question that popped up from the audience that I want to make sure we address before we get to our closing question. At the moment, Bitcoin, says the SEC, is not a security, and therefore, under tax law, the wash sale rule does not apply to Bitcoin or to Ethereum because they're not securities. But Congress is talking about closing that loophole in the new tax bill. So if the wash sale rule suddenly applies to Bitcoin and Ethereum, is that going to have an impact on the frequency of rebalancing that you can engage in? Any of you want to tackle that?
Yeah, I'll touch on that. So I would say rebalancing, if your Bitcoin's gone up this year, right? So like if you're rebalancing, you're going to take gains at this moment, no matter what. So that doesn't really change the wash sale rule, right? Because you're taking gains. What it would change is that Bitcoin drops 50% from here. You can't sell and buy back, you'd have to wait, instead of waiting 60 seconds, you have to wait 30 days. However, in a multi-asset portfolio, you could sell ETH, buy Solana, right? Kind of like the sell Coke, buy Pepsi in the traditional world. So in a multi-asset portfolio, the tax loss harvesting advantages won't go away. But if you just own Bitcoin, you basically have to wait 30 days for that to go by. And we expect the wash sale rule to apply for all crypto assets moving forward. So you'd want to start understanding that and not try to take advantage of the wash sale rule until that's figured out. So those are my thoughts on that.
Matt, did you want to weigh in?
No, it just changes a little bit the dynamics. That's it. You can't sell. So just that.
So we just have to pay attention to taxes and fees whenever engaging in any of these strategies. So one final comment I'd like you to leave for everybody. Just tell us the one takeaway that you want advisors to have about this space and the investment management strategies that we've discussed here. Start with you, John Maier at Global X.
I think we're in the very early innings of the adoption of digital assets across the financial services sector, from banking to capital markets to asset management, custody services. And I believe the proliferation of digital assets and the increased adoption of blockchain technology has the ability to really disrupt the way we actually conduct business on a day-to-day basis. And we're going to have to rethink asset allocation and how you properly include that in a broader asset allocation, particularly in an environment where inflation is higher. Perhaps cryptocurrencies will play a positive role in that aspect. You kind of have a younger generation of investors who are very attracted to this decentralized form of currencies. So it's a game changer.
And Matt Kolesky of Arbor Capital, what's your takeaway?
Yeah, I like what John said and something I mentioned earlier, right? This is an asset class that is more than that. It's technology that's not only going to change how a portfolio allocation is going to look, it's going to disrupt the traditional financial infrastructure, right? We're going to have digitally native portfolio managers, digitally native interactions with clients and the blockchain itself. And Rick, to your point, and one of the presentations I've seen you make before, the trust industry, right? Things are going to get replaced by code, and people need to be prepared for that. And advisors need to be thinking about how this can not only fit into their portfolios, but into their practice.
And Chris King of Eaglebrook Advisors.
Yeah, so I think my biggest thing that I try to educate advisors on is that if you're going to invest 2 to 6% of your client's portfolio, you want to invest directly in Bitcoin and the digital assets. And this is because there's limited tracking error, there's customization, there's easy to rebalance and report on these assets. So the security's there, the compliance is there, the infrastructure is there, the integrations are there. If you're going to do this in a meaningful way, you want to do it with a direct offering because of the tracking error with a lot of other aspects of the market.
All right, gentlemen, thank you so much for joining us on this panel today. Really, really appreciate it. John Maier of Global X, Matt Kolesky of Arbor Capital, and Chris King of Eaglebrook. Thanks very much, gentlemen. Our next and final session of the day, overcoming the 15 most common digital asset investor objections. And a little bit of housekeeping note, we're going to take a 2-minute break as we go to the next Zoom room. I need to set up my PowerPoint to be able to present that for you. So we're going to take a 2-minute break. We'll see you in the next Zoom room right after that. Thanks, gentlemen.